Are you sitting down? Because we need to have a serious, unfiltered, honest heart-to-heart conversation about your money, your future, and the silent thief waiting to take a massive slice of your hard-earned retirement savings. People come to me all the time and say, "Susie, I worked for 30 or 40 years. I paid my taxes on every single paycheck. Finally, I'm retiring. Tax season is going to be simple now, right?" Wrong. Oh, you are so wrong, and if you do not wake up to this reality right now, you are going to get slammed with a tax bill that will make your jaw drop. You think taxes get simple when you stop working? Taxes in retirement are actually more complicated than when you had a single W-2 job. When you were working, you had one primary income source. You filled out a W-4, your boss withheld taxes, and that was that. In retirement, you are the boss. You are juggling Social Security, traditional IRAs, 401(k)s, Roth accounts, brokerage funds, pensions, and interest. If you pull from the wrong account at the wrong time, boom! The IRS takes a bite out of your money that could have stayed in your pocket. I want you to stand in your power and stop being afraid of the taxman. Fear comes from not knowing. So today, we are stripping away the confusion, kicking the jargon to the curb, and giving you the exact blueprint to make your retirement taxes truly simple, safe, and smart. Let's start with the biggest shocker for most people, Social Security. Do you believe Social Security income is completely tax-free? If you said yes, I need you to listen to me. Up to 85% of your Social Security benefits can be subject to federal income tax. Read that again, 85%. How does that happen? The IRS uses a little formula called your combined income. They take your adjusted gross income, add any tax-exempt interest, and then add half of your Social Security benefits. If that number goes over just $25,000 for single filers or $32,000 for married couples filing jointly, guess what? You trigger federal taxes on your benefits. Those income thresholds haven't been updated for inflation in decades. They are tax traps. And when you take a chunk of money out of your traditional 401(k) or traditional IRA to buy a car or fix the roof, that distribution counts as ordinary income. That extra income pushes your combined income higher, triggering taxes on more of your Social Security. That is what I call a double whammy, and it catches millions of retirees off guard every single year. And speaking of your traditional 401(k) and IRA, I want to remind you of something critical. That balance you see when you log into your account? That is not all your money. It's a shared account with Uncle Sam. You got a tax deduction when you put the money in, but now, every single dollar you withdraw is taxed as regular income. Then, when you turn 73 or 75, the government forces you to take out money whether you want to or not. These are called required minimum distributions, or RMDs. If you don't take them, the penalty used to be 50%, and even though it's dropped to 25%, that is still your money going down the drain for making a simple oversight, not to mention Medicare. People think Medicare Part B premiums are a flat rate for everyone. No, no, no. If your income spikes because of an IRA withdrawal or selling an asset, you trigger IRMA, the income-related monthly adjustment amount. That means you pay extra surcharges on your Medicare premiums. One bad tax move can cascade into higher taxes and higher healthcare costs. Are you feeling anxious? Good. Channel that energy, because fear without action gets you nowhere. Now I am going to tell you exactly how to fix this. First, you must understand the 3 buckets of retirement money. Bucket number 1 is taxable, checking, savings, standard brokerage accounts. Bucket number 2 is tax-deferred, traditional IRAs, 401(k)s, 403(b)s. Bucket number 3 is tax-free, Roth IRAs, Roth 401(k)s, and health savings accounts, HSAs. Your actionable takeaway starting today is to create tax diversity. If all your money is in bucket number 2, you have trapped yourself. Every time you need cash, you force a taxable event. If you are still working or recently retired before RMD age, look into Roth conversions. A Roth conversion means moving money from a traditional IRA into a Roth IRA, paying the tax now at your current rate, so that every single dime grows tax-free and comes out tax-free for the rest of your life. No tax on withdrawals, no RMDs, and no pushing your Social Security into higher tax brackets. Second, master your tax bracket filling. Do not wait until April to see what you owe. Look at the tax brackets each year. If you are in the 12% bracket, pull just enough from your traditional IRA to stay right up to the top edge of that 12% line without jumping into the 22% bracket. If you need more income beyond that limit for the year, pull the rest from your Roth IRA or your cash savings. That is how you control the IRS instead of letting the IRS control you. Third, if you are 70 and a half or older, use qualified charitable distributions, QCDs. If you give money to charity, do not write a check from your personal checking account. Have your IRA custodian send the money directly from your IRA to the charity. That distribution counts toward your required minimum distribution, but it does not count as taxable income. It satisfies the IRS requirement without raising your AGI, preserving your Social Security tax status, and keeping your Medicare premiums low. Financial freedom isn't just about how much money you accumulate, it is about how much money you keep. Stop leaving your retirement security to chance. Get proactive, review your withdrawal order, leverage Roth accounts, and protect every single dollar you spent a lifetime earning. You can do this, you deserve to do this, and you must do this. Stay safe, stay strong, and protect your wealth.